The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Monday and a warm welcome to Squawk Box Europe. I'm Juliana Tattlebaum and these are your headlines. European futures point higher following Friday's market rout as fears ease that a series of bad loans stateside could widen into broader credit risks. UK Chancellor Rachel Reeves tells CNBC she will address the challenges facing the British economy in next month's budget, but insists she remains steadfast to her fiscal commitments.
I'm determined almost to be honest with people about the challenges that we face, and I think people can see the changing global environment we're in. I will respond to those as a responsible Chancellor at the budget in November.
Kering does a €4 billion beauty deal with L'Oreal as new CEO Luca De Meo looks to slash the company's debt and refocus efforts on fashion. A very warm welcome to the program. Good morning. Hopefully you had a restful weekend after last week's market turbulence. What a week. We have been talking for weeks, if not months now, about the possibility that we are in bubble territory, whether we should be concerned about risks mounting in the credit world. And last week, those concerns came to the fore. Let's take a look at U.S. markets and how we closed out the turbulent week on Friday. We actually saw a bounce back in U.S. markets. All three of the majors ended Friday's session higher. The NASDAQ gaining about 0.5%, S&P and the Dow gaining a similar percentage. This, of course, after the sell-off that we saw on Thursday, led by the U.S. regional banks. Concerns over credit quality in the U.S. economy dragged those banks lower. This is a look for you at how the regional banks traded on Friday. A rebound across a number of the key names. Zions Bancorp up almost 6%. You saw Western Alliance rally about 3%. But again, this comes after the steep sell-off that we saw the previous session. Here's a look for you at where the U.S. regional banks traveled over the course of the week. You can see the steep sell-off that came on Thursday. And for the week overall, you are looking at losses across the sector. We're going to talk a lot more about how concerned we should actually be about the regional banks in the U.S. and broader credit quality throughout the program. As for Asian markets, quite a different tone. You're looking at strong gains across the board in Asia overnight. The Nikkei 225 in Japan up more than 3%. Fresh records there. A lot of focus on the Japanese political situation with stocks trading sharply higher as Takaichi heads for the premiership amid hopes around a fresh coalition. So again, we'll talk more about that story later in the show, but that is driving the Japanese market higher. As far as the broader region is concerned, we've got some more optimism around the U.S.-China trade situation. President Trump offering some optimistic comments on Friday, which helped support sentiment stateside on Friday, helped drive that bounce back that you saw just a moment ago and seems to be driving sentiment in Asia as well. As for European markets, we closed down on Friday about 1%, but we're looking at gains there as well. So taking the lead from the Asian session, you're looking at gains across the board. The CAC looking to bounce about 0.6%. As you heard in the headlines, we're going to talk a lot about this deal on the show, the L'Oreal Kering beauty deal. I think will catch many investors off guard. We'll see how those stocks trade at the open. Kering looking to sell its beauty business to L'Oreal. Fascinating movement there. Finally, in terms of U.S. futures, here's the early indication for stateside trade today. You're looking at further gains. So that bounce back that we saw on Friday looks like perhaps it has legs. You're looking at the Dow adding about 125 points at this stage, the NASDAQ adding about 100 as investors digest those credit concerns that we just talked about. Now, Moody's Ratings head of global private credit, Mark Pinto, told CNBC there's little evidence of a systemic problem in the banking sector as a whole.
When we dig deeper here and look to see if there's a turn in the credit cycle, which is effectively what the market seems to be focusing on, we can find no evidence. Now, that's what we're seeing today. That could always change. But if we look at the asset quality numbers that we've seen over the last several quarters, we're seeing very little deterioration at all.
Let's welcome Johann Schultz to the program, senior equity analyst at Morningstar, to get his take on how concerned we should be about these credit fears. Johann, always a pleasure to speak with you, especially this morning as the markets digest these concerns that have been bubbling for a while but really came to the fore last week. What was your initial reaction to the sell-off that we saw in U.S. bank stocks last week, the regional lenders, and how concerned we should be about whether we do actually have a credit problem?
Yes, I think we think for the European banks, if you kind of take a through the cycle view, current provision levels are below what we would view as normalized levels. Probably European banks would need to increase provisions by about 50% to get back to a mid-cycle level. Now, that sounds extreme, but what we've also seen is that the profitability for European banks has improved quite a bit, with higher interest rates. So there's a bit of buffer to absorb these higher provisions that will come over time. So the impact on earnings for European banks, we kind of estimate around about 10% lower if you normalize credit costs. However, as you know, the credit cycle never really just goes back to mid-cycle or normalized levels. It tends to overshoot sometimes. And I think what we saw last week is concerns that we are entering into a period where there's going to be sustained pressure on credit.
When it comes to the exposure of European lenders, how exposed are they to overstretched U.S. corporate borrowers? It sounds like we should be concerned that they do have exposure, material enough exposure that's going to lead to more provisioning.
Yeah, I mean, and it depends quite a bit which bank you're talking about. The larger corporate and investment banks, the likes of a BNP, Deutsche, those have got larger exposures, whilst the more domestic focused players have got less exposure to the US. On average, you're probably looking at about 15% of balance sheets, but that differs quite a bit. But I think the concern is maybe a little bit broader, that it is about the impact that global pressures on the global supply chains are having on the cash flow position of firms globally and also European firms. One also thinking especially about European firms that are exposed to the impact of tariffs, for instance.
When it comes to the overstretched U.S. corporate borrowers that are worrying right now, how would you characterize them? Are these the more export-oriented, export-dependent names that are impacted by tariffs? Or what are the factors we should be thinking about when we think about the most vulnerable borrowers here?
Yeah, I mean, the two names that I think have been at the center of it has been Tricolor and First Brands, and both of them are exposed to trade, import and export side of things. And then both of them have been also quite reliant on trade finance, on securitization of their receivables. So, I think that's kind of some of the characteristics that's coming to the fore. And then, yes, both of them are very highly levered entities exposed to leverage loans, private credit. So, I think that's some of the commonalities.
We've been talking about the risk of the around banks' interconnectedness with private markets for a while now. And you hear private credit funds say, nothing to worry about here when it comes to the bank's exposure. It's quite safe exposure. And you're hearing the same from the banks. And yet regulators, central banks around the world have certainly raised the alarm bells that this is a risk we should be thinking about here, the interconnectedness of banks with private credit funds, with private markets. How would you characterize the risk there and the interconnectedness?
Yes, I mean, there's definitely a lot of touch points between banks and private credit, and the broadly syndicated loan market, which is essentially leverage loans being originated by the banks. But banks also lend to private market firms on a fund level. They lend to private market firms on a GP level. So, there's various touch points. And I think the crucial bit to look for is what happens to liquidity. The moment that you start seeing pressure come through on liquidity, that can translate into further pressure on credit quality.
No, of course, that makes a lot of sense, Johan. Let me wrap up with a question heading into earnings season. We saw a sharp sell-off in the European banks last week in response to this turmoil stateside. What's priced in terms of earnings season, in terms of where analysts are at with regards to this provisioning that you talk about, where we should expect to see an uptick in provisioning here?
I don't think it's priced in at all at the moment. We see European banks probably overvalued by about 20% on average. The sector, it's been very strong this year. We've been surprised by the strength of European banks, given that the interest rate cycle has turned. We don't really see where additional growth and increase in profitability is going to come from. And then, you need to see credit losses normalize at some stage. So I think that's part of the reason for the aggressive sell-off is that European banks have certainly started to look toppish.
Johan, thank you so much for your views this morning. Johan Schultz, Senior Equity Analyst at Morningstar. UK Chancellor Rachel Reeves told CNBC the country will continue on a path of fiscal consolidation, and she's determined to reduce the cost of borrowing. Reeves said that November's much-anticipated budget will look to respond to a changing global environment, including greater trade barriers, tensions in the Middle East, and Russia's ongoing war in Ukraine. Kering spoke to Reeves on the sidelines of the IMF World Bank meeting in Washington and began by asking her whether she is concerned about the gilt market and whether Labour can afford to reduce public spending politically.
We will always meet the fiscal rules that I set for this government at my first budget last year, that we will balance day-to-day spending with tax receipts and that we will bring debt down as a share of GDP. And financial market participants can see that in the budget last year, in the spring statement this year and in the spending review in the summer, I continue to meet those fiscal rules despite the pressures that we were under. And that will continue to be the case, and we will continue to see our budget deficit fall, in contrast to many countries around the world where those budget deficits are increasing. And we will do that based on the forecast that we get from the independent forecast of the Office of Budget Responsibility, with a combination of tax and spending measures. And I'll set those out in November. But the key thing for me is that as Chancellor, I'm determined almost to be honest with people about the challenges that we face. And I think people can see the changing global environment we're in, whether that is Russia's ongoing aggression in Ukraine, the disruptions and the tensions in the Middle East, or indeed the impact of trade barriers increasing throughout the world. And I will respond to those as a responsible Chancellor at the budget in November.
Is the bond market, though, overreacting to the potential for public spending cuts?
I'm not going to comment on bond market moves, but I do want to reassure people that whatever forecasts come my way, we will continue to meet those fiscal rules. We will continue on that path of fiscal consolidation because we know that the deficit has been running too high for the last few years. And as Chancellor, I'm determined to reduce those costs of borrowing, bring down the debt and ensure that we have a growing economy based on that platform of fiscal responsibility.
You've been talking to banks here in DC about improving competitiveness for the lenders. Does that mean you can rule out a bank tax in the budget?
I'm not going to comment on the individual measures in the budget, but I want Britain to be a competitive place for businesses to start up, to scale up, to grow, and also for international investors to invest. That's why just yesterday we announced a new concierge service for financial services firms wanting to start up and grow in the UK. It's why we've doubled the number of visas for global talent, including for high-earning individuals and entrepreneurs, because we want Britain to be seen globally as the place to trade, the place to invest, the place to do business, and the place to bring global talent.
Karen also sat down with some of the UK's biggest names in financial services and got their take on the health of business in the country.
There's a fundamental gap between the figures and sentiment. I mean, you're right. When you look at the figures, as the IMF said, good growth figure, modest growth figures. So it's in a poor league, but nevertheless, there's growth. Inflation high, but still low single figures. Unemployment 4.8%. You look at corporate balance sheets, you look at savings rates, you look at mortgage applications up. All of the figures, you look at that and say, situation okay. Government has a very strong growth agenda, but sentiment is dipping. And there's the confidence isn't there.
The UK stock market has been at record highs. Nobody really saw that. We've had the yield come down this week. You had an IPO the other week. This was an AI data center Texas firm, Fermi. What are you seeing in terms of signals around the UK economy?
So I'd pick up on some of what Rick was saying in terms of a little bit of a gap between the numbers and sentiment. As you said, record highs for the markets. We are seeing capital flows. It's not a rush of capital coming out of the U.S. into the U.K. the way that the narrative had sort of positioned it after Liberation Day. But we are seeing capital flows coming into the U.K. We have a healthy pipeline. You mentioned one. There have been actually a number of IPOs over the last few weeks and more to come. And the broader market is frankly, digesting a little bit of this difference between sort of the common narrative and what is actually going on the ground. We have seen very significant reforms in terms of the capital markets over the last few years that have made it much simpler, much more flexible for companies to list.
Coming up on the program, Kering agrees to sell its beauty business to L'Oreal in a major restructuring step. Plus, China's economy grows at its slowest pace in a year as investment drops. And we'll dig into the AI outlook with Paul Bloch, co-founder and president of data storage company DDM. That conversation coming up at 8:30 London time. Welcome back to the program. Kering and L'Oreal have struck a €4 billion deal in the beauty space. The agreement will see L'Oreal acquire Kering's perfume line Creed, as well as licenses to develop products under the luxury giant's fashion labels Gucci, Bottega Veneta, and Balenciaga. What a deal to talk about this morning. Charlotte joins us now with more on it. Charlotte, what a bold move from the new CEO at Kering. Luca De Meo hasn't been in the seat long to be shaking things up like this.
No, just since mid-September, very big first move there, and a big strategic U-turn as well for Kering. So very interesting to see this announcement. But look, when he was brought on board, Luca De Meo, he was the turnaround guy. That's what he did at Renault, and that's why he's expected to do at Kering. And we know the issues that they've had, and we'll go into details into this. But this deal, there had been some rumors over the weekend about this potential alliance between Kering and L'Oreal around beauty. So these €4 billion payable in cash that will be closing in the first half of 2026. L'Oreal will also be paying royalties to Kering for the use of their licensed brand. So that's the sale of their high-end perfume Creed that Kering bought only back in 2023 for a reported €3.5 billion, and that was the start of that beauty division just then. But now with this deal, Creed will move to L'Oreal, and then L'Oreal also already make the Yves Saint Laurent beauty since 2008 for Kering. They also do Valentino for the perfumes and makeup, and now they will add to their portfolio the brands of Bottega Veneta and Balenciaga with 50-year licenses, and they will also get Gucci from around 2028 when the license with Coty comes to an end. So, a big deal there with all the brands between the two groups. So for a lot of analysts, this is a positive sign because it means that Kering is refocusing very much on their fashion business. And that's kind of what we were expecting from Luca De Meo there, because there have been some concern around the debt at Kering in particular that stands at €9.5 billion at the end of June. So they're, start to clean up the house there. Other moves that we saw from Luca De Meo recently, he delayed the full acquisition of Valentino by a couple of years there. Also changed the management team, very much retightening the team around him and assigning a new CEO at Gucci, because we've talked many times about how the success of Gucci is instrumental to the success of Kering. They make the bulk of their profit, and Francesca Bellettini has taken the helm of Gucci. So big move there from the new CEO that, as you say, has joined only in September. They actually have results just this week, both L'Oreal and Kering. So we'll have more details potentially around this alliance and around the turnaround of Kering as well.
Really great detail and context for what this, this means for Kering. But what about for the L'Oreal side of things. What does this deal mean for L'Oreal, the strategic rationale for them taking on this beauty business?
Yeah, they made some big acquisitions again under Nicolas Hieronymus, the CEO that came on board just a few years back. They bought Aesop, you remember, 2.5 billion euros back in 2023. But they are the biggest player in the field and they have a lot of firepower. So again, for a lot of analysts, the tie-up between Kering and L'Oreal can make sense because we know the savoir-faire of L'Oreal when it comes to this, to have the licenses of many luxury names as well to develop their fragrances and makeup. We know that makeup has had good success. It's kind of the bridge to some of the aspirational buyers, especially when luxury has become so much more expensive. We know that beauty has been one, and fragrances has very much been booming over the past couple of years. And so, the acquisition of Creed for L'Oreal very much makes sense on that front.
And what's the early indication in terms of analysts and investors, what they think of this deal, the initial reaction this morning?
Yeah, for RBC, they said they see it as, again, potential on that deal because it shows a refocus in terms of strategy for Kering. They say there is some question of what happens for eyewear at Kering as well, because when there was this vertical integration there, does that mean that they're changing their strategy on that front as well? And I'm sure that will be one of the questions that is asked to the group when they have their earnings. But for City as well, they say it's a surprising U-turn, but again, they see it as a positive because it's also less capital intensive for Kering to just license the beauty rather than try to develop it themselves.
Well, fascinating, and we're not too far away from when we'll see the opening moves for both those names. Stay with us, Charlotte. We've got more news we want to ask you about. S&P Global has made a surprise downgrade to France's credit rating to A+ from AA-. The agency cited policy uncertainty as a key drag on the wider French economy, noting that while the draft budget for 2026 has been submitted to Parliament, issues around government finances are unresolved. Charlotte, to what extent is this a surprise for the market?
So it was a surprise because the decision from S&P wasn't expected until November. This is the third downgrade in a year. But I would say that the content of the downgrade is not a surprise to a certain extent. And we know the upheaval that we've seen in French politics, so now downgraded to A+. So now France has lost its double A rating at 2 of the 3 major agencies. And Moody's is the last one that has it, and they have their own review on Friday. So we'll have to wait and see what happens there. But certainly the question of public finances. But that's interesting because we saw last week the government survived 2 votes of no confidence. One was very tight, but just 18 months they survived. And that's thanks to the government and Sébastien Lecornu, the new prime minister, saying he would suspend the pension reform, therefore having the support of the socialists. And we saw short-term relief, including on the market, that this government wasn't going to fall straight away, as we've seen with previous governments. But the long-term questions, remain, if not are greater, because the question of the pension reform was to tackle some of the public finances. And we know that the suspension of the pension reform will cost 400 million in 26 and 1.8 billion in 27. Now, the government said they will compensate those and they will have to find ways to compensate it. But as we know, it's a fragmented parliament. It might be tricky to find it. So we expect to see some tax hikes. We'll have to wait and see. Debate actually in parliament start today around the budget. So it's a good thing the debate is happening. Could have not been happening if the government had been topped last week. But the long-term questions remain. And S&P, they actually see the debt of France at 121% in 2028 if we don't see further measures to try and tackle the deficit of public finances. So long-term questions very much here to remain.
So short-term, a bit of relief, but long-term, lots more question marks. Charlotte, thank you for breaking down both those stories for us. Now, Karen caught up with the IMF's director of the European Department, Alfred Kammer, and asked for his outlook on France.
France is managing the pressures right now well. French policymakers have understood that fiscal sustainability needs to be an objective, and they are working on it. And whenever you're working on fiscal sustainability, bringing the deficits down, of course you have political disagreements along the way, but they're all focused on actually trying to produce a lower budget deficit for next year, staying within the European fiscal rules and dealing with these fiscal trade-offs. And market have clearly shown confidence that they expect a successful outcome. And so do we.
What about the worst case scenario though? Because the realistic scenario is that we've gone from government to government. It's very hard for any passing of a national budget given competing interests. If France does not hold together and does not pass a budget, could there be blowback for the rest of Europe given the huge ambitions that Europe has?
Yeah. It's clear whenever we see these fiscal adjustment discussions, they're difficult. And I think what we do in our regional economic outlook, we are projecting that when you're looking at fiscal adjustment needs, they will be large across Europe also in the future. We are projecting under unchanged policy, given all of the spending pressures we have, and one of them is advanced on national defense, European debt levels would double in the next 15 years for the average European countries. And that requires then fiscal adjustment. That requires a discussion with the population of what are the spending priorities, what is acceptable on the taxation side. And so this is not just a discussion which is going to happen in France. This is an issue which is starting more widely in Europe. And it needs to take place, and it's going to be harsh. And you certainly don't want to lose the credibility of market while you're having these discussions.